Hello everyone, my name is Victor Lai with BCM and welcome to part 2 of Learn About Stocks. In this part, we're going to talk about stock prices and why they move. In part 1, we ended by saying that investors will buy stocks for a number of different reasons, but usually they are hoping that the stock price will go up so that they can make money, which brings us to the current question, which is why do stock prices move up and down? There are lots of different reasons, but I'm going to generalize into two very broad categories. The first one is what something I call operating results. Operating results basically show if a company is making money. Obviously, all companies need to make money. Companies can have different missions and objectives, of course, but at the end of the day, they have to be profitable, because if they're not, they're going to go out of business and then all missions are over. Now, if a company is making money, then logically we would think that the value of that company will go up. And all else being equal, the value of that company's stock should also go up. And of course, the reverse is also true. If the company is losing money, then the value of the company and the stock should go down. Now, in the United States, public companies are required to submit regulatory filings that show operating results. Quarterly reports are called the 10Qs. Annual reports are called the 10Ks. And all of these reports are available to the public, and you can find them, in a number of places all over the internet. But one good place you can go is to the SEC's website using their EDGAR tool. Now, in these filings, in these reports, we're going to find financial statements. Financial statements are basically just documents that show a company's operating results in numbers, in dollars and cents. There are a few different financial statements, but for our purposes, we're just going to look quickly at two of the most commonly referenced statements. The first one is called the income statement, also known as the P&L, or profit and loss statement. This report shows how much money a company made or lost over a period of time. Usually that's over the course of a quarter or a year. The income statement is going to list out all of a company's revenue, all of its expenses, and then the difference between those two things, revenue minus expenses, is equal to income, which is the profit or loss, and it's commonly called the bottom line because it is at the bottom of the income statement. The second report is called the balance sheet. This is also called the statement of financial condition. This report shows how much a company is worth at a specific point of time. Usually that's going to be at the end of a quarter or the end of the year. The balance sheet lists all of a company's assets, all of its liabilities, and the difference between those two things, assets minus liabilities, equals equity, which is also called book value or net worth. Now, using just these two statements, we can visualize how operating results actually translate into changes in stock price. And we'll do that next with an example. Okay, on this page, what we have here are 3 years worth of income statements and balance sheets. So across the top in black, we see year followed by 0, 1, 2, and 3. Each numbered column represents a point in time. So 0 represents today, 1 is 1 year from now, 2 is 2 years from now, and so forth. Below years, we see the income statement in blue. And as we just learned, income statement is going to show us revenue, expenses, and income. Below that, we have the balance sheet in green. And as we know, that's going to show us assets, liabilities, and equity. So let's start our example at time 0. Okay, let's say that today we're going to start a brand new company. Since we are a new company, we don't have any revenue, we don't have any expenses, we don't have any income. That's why we see a bunch of zeros at time 0. If we move down to the balance sheet, we see that we do have some assets, and that's because in order to start this company, we needed to come up with some money. So let's say we invested $100 cash to start this company. That's why you see $100 listed as an asset. We have no liabilities, and so we know that our equity is assets minus liabilities, or $100 at time zero. After 1 year, let's say we're able to sell $50 worth of stuff. Over that same period, we spend $40 in expenses. So at year 1, we have an income of $10. So 50 minus 40 equals a profit of $10. Now, when we move down to the balance sheet, we can see how this profit actually affects the value of the company. So we started at time zero with $100 in cash. At year 1, because we made $10 of profit, our cash is now $110. We have no liabilities, and so our equity now is also $110. Now, I want to point something out here. In a perfect world where there are no other factors, no other considerations, a company's equity value should be equal to its stock value. So, for example, if this company here only has 1 share of stock, okay, that 1 share of stock at year 1 should be equal to $110. At year 0, that 1 share of stock should have been equal to $100, right? So this is why stocks are commonly referred to as equities or equity investments, because in a perfect world, they're one and the same. Okay, so we're going to move on with our example to year 2. At year 2, we have $40 in revenue. Our expenses are $60, and so that results in a loss of $20. 40 minus 60 is negative 20. Now we can see how this affects the company again when we move down to the balance sheet. Remember, last year at the end of year 1 we had $110 in cash. Because we incurred a $20 loss, our cash is now down to $90. We still have no liabilities, and so our equity now at year 2 is $90. Okay. Finally, year 3. Year 3, our revenue is $60. Our expenses are also $60. So that results in 0 profit or loss. So the income statement really doesn't do anything to the balance sheet in year 3. You can see that our assets are still $90. What does change here, though, is that in year 3 we incur a liability of $20. Now, it doesn't really matter what that liability is. The thing I want to point out is that it does affect the company's value, right? Remember, equity is assets minus liability, so in year 3 equity has now fallen to $70. And again, in a perfect world, our 1 share of stock is also worth $70. So, this is a very simple example, of course, but this is basically how operating results will affect stock prices. Now, you hear me say in a perfect world and all else equal and stuff like that, because in reality, stock prices are influenced by more than just operating results. In the real world, a stock's market price is going to be different from the reported equity value, from the reported book value, and it can actually be different by a very large amount. And that's because in addition to operating results, market price is also influenced by the supply and demand for the stock. So if we ignore operating results, investors can want to buy or sell stock for all kinds of different reasons: economic, political, social, personal. It doesn't really matter what the reason is. Investors are entitled to their own opinions, and so the overall sum of all those opinions is going to create supply and demand for the stock. And that's really what the market is, right? The market is just, the aggregate opinions of all investors. So the point here is that a stock's market price really has 2 parts. Okay, the first part is due to the company's operating results, represented by book value. The second part is the supply and demand for that stock from the market. I'm just going to call that generically the market, right? So what I mean by that is, the market, the supply and demand from the market has an impact on the price, okay? And the thing to keep in mind about the market impact, the market element, is that it is not as clear cut as operating results and book value, right? So financial statements, they're reported in black and white in dollars and cents, right? But there's no report like that for the market, right? The market is very intangible and very uncertain. Okay, the only thing that we know about the market and the market effect is that it exists, and that it can have a very large impact on the stock price, right? And ultimately, it is the market and the market effect that makes stock investing risky, right? It's because the market always introduces some amount of uncertainty into a stock's market price. Now, if we take all of this together, we can kind of see how it works from top to bottom. Okay, so this chart, we're going back to our financial statement example. Now, what we've added here at the bottom in the red box is the market effect, right? The impact of the market. So for example, at year one, we know that at the end of year one, our book value is $110. Again, in a perfect world, our stock, our one share of stock, would also be worth $110. But we have to take into account the market effect. In this case, at year one, we're saying there's a market effect of plus 40. Right, so what that means is you've got a book value of 110, there's a market effect of 40, and so that brings us to the bottom line here. The market price becomes 150. Now you might wonder, why would anyone want to pay $150 for a stock that's only worth 110 by the books? Well, let's say that I feel very good about this company. I like it a lot. I think it's going to be worth $500, and so I'm happy to pay $150 for it. Maybe I'll pay even more. You might disagree, but this is my opinion, right? And the truth is, if there are enough people who believe in the stock and who like it, the price can just keep going up as demand outpaces supply. And of course, it can work the other way as well. So if you look at year two, we see that the equity value, the book value, is $90, but because of a negative market effect, the market price goes all the way down to $60. Right? So this happens all the time. Market price very often will deviate from book value. One very good example right now is a stock like Tesla, the electric car maker. Tesla as a company has a history of losing money. It's unprofitable, but its stock price has really soared since it went public, and that's because there are enough people, enough investors who believe in it. As of right now, Tesla has a book value of somewhere around $30 a share, but its market price is well over $300 per share. So less than 10% of Tesla's market price can be explained by its book value, by its operating results. Some people would say, well, expectations are too high for Tesla, but I don't know if it is. Honestly, nobody really knows for sure. And again, that's what makes the market, that's what makes stock investing risky and uncertain, because no one really knows, right? No one really knows. Okay, so that basically wraps up this part. As a quick summary, stock prices are going to be influenced generally by two things. Okay, first, we have operating results and book value, and second, you have supply and demand in the market. So if you looked at it as an equation, market price equals book value plus or minus some type of market effect. If you want to know more about a company's operating results, a good place to look would be the SEC's website using the Edgar tool. As far as the market is concerned, the market is something that is less easy to analyze and study because it really reflects the aggregate opinions of all investors. It is really intangible. It's unknown, and it's what makes stock investing so uncertain and so risky. Okay, in the next part, we're going to look at some common approaches to stock analysis. I think that's going to help apply some of the information that we've gathered so far, so I hope that you'll join us for that. If you like this video, please like it, please share it. You can find us also on Facebook, Twitter, and LinkedIn. I've included links below. We post information every month, so if you subscribe to our pages, we can keep you up to date with the content. Thanks for watching, and please stay tuned for some additional information about this presentation.